Hello and welcome to Market Domination. I am Josh Lipton alongside Madison Mills, live from our NYSE headquarters, and we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
That's right. Here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I think the market is sending a very clear signal that the deficit spending that has gone on for years and continues in what is a pretty healthy environment from an economic standpoint is going to likely influence rates higher for the foreseeable future.
The convergence of the demand curves for fiber and wireless in the consumer space. And AT&T has the scale, the brand, the footprint to really compete and invest in that business. So we chose to double down where we have a right to win and sell the business to AT&T on the consumer fiber side and retain our ability to really serve the enterprise.
We are just getting started in the spring home buying season. Critical months for the home sales activity, which happens, from spring all the way to late summer. And the current activity at 4 million. This is 75% level of normal. Now, pre-COVID, we had home sales running at above 5 million, but now we are running at 4 million. And this is due to the fact that not that people do not want to buy a home, but affordability challenges.
We've got 1 hour to go until the market close. We're taking a look at the major averages. You got green across your screen. The S&P up about 0.5%. Your tech-heavy NASDAQ up 0.9%. Josh, we've really got a lot of those big tech names carrying the weight today. You can see here on your screen all of those Mag 7 members in the green.
We do have some green today. Of course, that's after a tough day yesterday, right? The focus, I think, Maddie, for a lot of investors, still bonds, it's still on yields. Last I checked, the 10-year was knocking on 4.6.
Yep.
But despite that, and obviously it's not just the level. I think what's getting a lot of people's attention, it's the speed of the move that you made there, which is making headlines. Despite that, despite where we're at, we are higher today, which I think is interesting. And I plan to ask a very smart strategist about that.
Yeah, it's definitely interesting, seeing a little bit of risk on sentiment across the board when it comes to stocks. If I can take a look over at a different asset, though, we've got Bitcoin here hitting record
grinding
highs.
higher. Yeah, look at that.
Grinding higher and hitting above 111,000 for the first time ever.
Yeah, so there's a few different kind of puts and takes with that. It is this kind of just constant grind here for Bitcoin. Yeah. You do have, you got the stablecoin bill in the Senate. I thought it was interesting. Bloomberg, I saw a note that those Bitcoin ETFs were drawing strong inflows. And then, of course, in the background, you do have the President of the United States. He is a believer. He's a big supporter. Yep. You got friends in high places if you're in Bitcoin. Yeah,
of course. And if we take a look year to date, up about 18%, certainly beating the broader indices.
Nice move. Well, for more on the latest market moves, let's welcome in here Lauren Sanfilippo, Bank of America Senior Investment Strategist. Lauren, it is great to see you. So let's start, Lauren, what I was just talking with Maddie about, which is let's focus on bonds. Let's focus on yields. I want get your take, Lauren. Explain the move we have seen, why you think we've made that move, and what that does mean for the stock market.
Yeah, a couple of reasons as to why the 10-year is butting up against that 460 level, like you said, Josh. I think number one, obviously, it's that deficit and debt concern. But is that really the new news here for the bond market? It's obviously the third credit rating agency with that downgrade to U.S. debt. But I think the bigger picture here is that recession risk has been taken off the table, right? We looked at the poly market odds of recession this year. They're closer to like 60% at the beginning of the month, right? De-escalation in the trade war. Now we're looking at like closer to 40% of an odds of a recession for this year, according to poly markets. So I think that has to do a lot with what we're seeing in the bond yield in bond markets now.
Is it a mistake for markets to be pricing out the risk of recession to that degree in your view?
No, we've thought this year, actually, the risk of recession, just not that great, right? So we've been in the camp of no recession this year. Maybe cuts are coming from the Fed next year, but we also think that the Fed is on hold. And you've seen a resilient consumer. The economy, I mean, you guys know the story here. The economy has fared pretty resilient as well. And so we think there are supports and reasons why, even in light of what's happening at the White House.
What are those reasons, Lauren? What would you say? Reasons why it's holding up.
Well, the consumer specifically, I mean, you have an unemployment rate that's close to 4%.
Yeah.
I do think there are some hairline cracks and delinquencies. You look at credit cards, not housing data, but credit cards, autos, right? You see some of those delinquencies hooking up. But generally, I mean, you know, debt service seems okay for the consumer. I will flag, though, in client conversations, there is some trade down, I think, and I'm just hearing this anecdotally. This is not reflected in the hard data, but I'm hearing anecdotally that there are some of those hairline cracks trade down, for example, in grocery store aisles.
And there is this idea, too, for the consumer that if tariffs were a headwind, that the tax bill is going to be some potential removal of a headwind when it comes to both markets and for consumer spending. To what degree do you think any of that potential growth in spending from consumers outweighs any concerns about the U.S. deficit that we're seeing play out in the bond market?
Yeah, I mean, it's interesting. We don't really know yet with the bill, right? We're kind of in like the third inning here. So it's hard to say exactly what will come through. But I think actually a more predominant factor, and maybe this isn't catching as many headlines, I mean, oil at like 60, that's a tax cut for consumers, right? So that actually serves as a tailwind. We're watching that closely.
You mean, to the extent, Lauren, you mean, okay, tariffs come and our friends and family take some type of hit, that could be offset by these lower energy costs? That's what you're driving at?
Yeah, I mean, that could be one factor. Yeah, for sure.
And when you think about how that is playing out in equities, one of the things I'm interested in today is that part of the recovery that we've seen in stocks is, of course, driven by the big tech names. Is that going to continue to be the area where we see investors flock amid the continued volatility?
Yeah, it's interesting because it makes sense that tech outperforms in a dollar weakening environment, right? I mean, you look at tech where those revenues are derived overseas, right? So U.S. multinationals generally will perform better in that weaker dollar environment. But I think for tech this year, I mean, sort of took it on the chin during the April drawdown. Now we're seeing sort of the Mag 7. Today, you said some of the best movers. I think that almost makes sense given sort of their re-rating this year. Now, given the earnings backdrop, their performance is narrowing, and we saw that through earnings, right? That deceleration in earnings growth, that second derivative. You look at an earnings, the 6 for the Mag 7, the 6 that have reported, close to like 30% year-on-year growth. I mean, that's incredible. Ex Nvidia, of course, it's coming.
Right, exactly.
Lauren, when you're talking to clients right now, just gauging their interest, are they interested in overseas, or no, they tell you, I'd rather just stay and rotate within the U.S.?
Rotate within the U.S. Predominantly. I think there was some concern just when like Europe, you know, was up 30%. You wonder what aspect in your portfolio is sort of cashing in on that, right? But I think at this point, and this is how we're advising clients as well, we still have this home bias, right? It's still the U.S. bias, and I think you have to have a lot of conviction to think that like Latin America is going to go on to rally 30% more, right? Which it already has done year to date. I'm waiting for that fundamental story to come through in Europe to really feel like a second leg of conviction, or that like the next leg higher will be overseas. And right now I just sort of think still it's US best in class.
So what does rotation within the U.S. look like? How do you generate alpha in that approach?
Yeah, I mean, so you have to look at the year-to-date leaders and understand that there's more to the story than tech, right? So value, we like that value tilt, and it complements that U.S. growth tilt. And on days when tech's not working, in a lot of cases, value is. And so that seems like a good place for us to put some new money to work. Even like utilities, we're not getting overly defensive, though, because that doesn't make sense to us, given our call that we're not really looking for a U.S. recession this year.
Right. No, makes a ton of sense. Lauren, thank you so much for coming by. I really appreciate it. President Donald Trump has taken aim at some companies in recent weeks over possible tariff price hikes. Quote, I'll be watching, the president told Walmart after CEO Doug McMillon said on the company's first quarter earnings call that even at the reduced levels, the higher tariffs will result in higher prices. Despite being known for their everyday low prices, Walmart is expecting the hikes to begin rolling out later this month. President Trump's tariffs equally impacting the automakers, Ford pulling its full-year guidance as they expect tariffs could have significant impact on the company bottom line. The auto giant also raising prices on 3 of its Mexico-produced models. The Mustang Mach-E electric SUV, the Maverick pickup, and the Bronco Sport will increase by as much as $2,000. It's not just retailers and autos seeing the impact here. Big tech feeling the pain as well. Microsoft raising the price on its Xbox consoles, games, and accessories worldwide. Customers now paying as much as $79.99 for some new Xbox games, up from $69.99, while the Xbox Series X console will jump $100. One recent success for the White House coming when Home Depot publicly pledged not to raise prices. The company executive Billy Bastick said on an earnings call with analysts this Tuesday that we don't see broad-based price increases for our customers at all going forward. We're going to continue to track these developments for you as they come out right here on Yahoo Finance.
And we're just getting started here on Market Domination. Coming up, AT&T set to acquire Lumen's mass markets fiber business. Our very own Brian Sozzi catches up with the company's CEO, John Stankey, on the other side to discuss that deal. Plus, Hinge Health to begin trading today on the New York Stock Exchange. We're going to hear from that company's CEO later in the hour to discuss what's next as they make their debut. Stick around, much more Market Domination still to come.
Yahoo Finance paying close attention to shares of AT&T, the company purchasing all of Lumen's mass market fiber business for $5.75 billion, I should say, will help the company offer more fiber options across the United States. Let's bring in AT&T Chairman and CEO John Stankey. John, always nice to get some time with you. So $5.75 billion for a brand or an asset that has 1 million customers, that's a big price. Why did you feel you had to pay that amount?
Hi, Brian. It's good to be back with you. And I think it's just a continuation of what you and I have been talking about, which as a company, we believe very strongly that ultimately consumers want to buy their internet service from one place, whether they're on the go and using a mobile phone or at home, entertaining themselves or doing important business. And what we're picking up is a little over 4 million past households. You're correct, there's only 1 million customers, but that's part of the attractiveness of this. We believe we can actually penetrate that base quite a bit more effectively, especially when we invest more heavily to grow the footprint and get the scale that's necessary to compete in fiber. So when you think about where we stand today, by the time we reach 2030, we'll have doubled our fiber footprint from about 30 million passings to 60 million. And we'll pick up probably a little over 10 million from this particular footprint that we're picking up from Lumen as we develop and build it out. So we're really excited about that opportunity, not only because of broadband, but these happen to be in markets where we're a bit under-positioned in share in our wireless business. So to the extent that we can do better on fiber broadband, we think in Seattle and Phoenix, in Denver, we can actually lift our share of wireless as a result of this. And that's kind of a twofer if we pull that off the right way.
Is that the not so secret play here, John, that you sell? I know you've called it converged in the past, but let's say bundles, where if you're a fiber customer, now you're going to belong to AT&T Wireless, and ultimately you will pay a higher price for all this stuff.
Well, you're buying two services, and you're certainly getting better functionality as a result of putting them together. And yeah, you're going to end up paying for each of the services, but you're going to be getting a value that's better than if you were out splitting them between two other companies. And as the forward momentum of our product development increases, you're going to get other features and benefits of having the two together. So for example, in the unusual event that your fiber goes out, the gateway will automatically back up to your wireless service. So until we can get out there to repair it, you'll have that kind of backup capability. And those types of things are really important to our customers who expect high value services.
Why is the competition so fierce right now for these fiber assets? I see what Verizon just acquired officially a couple weeks ago with Frontier. You have T-Mobile tying up in a joint venture with Lumos. Take me inside the state of play in the industry a bit.
Well, because fiber is the best technology, and it's going to be the best technology for the future, and they're all trying to catch us. So they're all flailing around trying to make sure that they can try to collect some footprint. And I think we just made a big move here that's going to not only increase our lead, but extend it further.
The cable companies must really hate what you guys are doing.
I can't speak to how cable's reacting. I can tell you that customers seem to be voting with their feet.
You mentioned that the deal is expected to close in the first half of 2026. How confident that you can get this deal passed inside of administration that coming into the year, many CEOs thought it was going to be a friendly administration to do deals. Not necessarily has that been the case.
Yeah, I think there's everything going for this deal when you think about it. First of all, we're investing in great infrastructure that makes the U.S. economy more competitive. We're going into footprints and markets where the previous owner didn't have the wherewithal and capability to do that. So we're going to step up investment of this world-class infrastructure that I think is right on policy for U.S. competitiveness. When we do that and we start building and investing, we hire people that have to trench and work in local communities to get that done. When customers buy the service, we hire people that shows up at somebody's home to actually install it and put it in and service it. And when you think about the dynamic of somebody investing in that infrastructure, it creates a more competitive market, which ultimately is great for the consumer as well. So it's really hard to see where a company like ours that has a bunch of good, solid, middle-class, union-represented jobs working in these communities isn't going to look at, somebody's going to look at this and say, we not only want this, we want this fast.
No, it makes a lot of sense, John. But, you know, going back to what Verizon and T-Mobile have gone through to get their deals passed, Verizon had to roll back certain DEI initiatives to get a sign-off from FCC Chair Brendan Carr. Same deal with T-Mobile. Are you prepared to make that same call, that if the administration says, John, we want to see roll back DEI, if you want to get this deal done, we're going to do it?
Well, we don't have to roll back anything, Brian. Our policies and our approach around AT&T have always been that we progress people on merit, that any employee that comes to work here should have an opportunity to grow their career, work on building their skills, have an opportunity to succeed and earn a living. And we want to help them do that. We want to help all of our employees do that. And that's always been our policy, and it will be our policy going forward. And our goal is to make sure that every employee that walks through the door of AT&T feels like they belong here, and it's a good place for them to work. And I'm pretty confident that anybody who examines our practices and how we run the business is going to come to that same conclusion.
So it sounds like you may take a different approach than your competitors in trying to get this deal closed?
Well, I don't want to prognosticate on the future when I have no idea what's going to occur. But as I said, there's an awful lot of good things for this deal where it makes perfect sense. And I feel like we run the business in a really responsible manner. We're right in line with the kind of things that this administration would like to see moving forward. So I can't wait to tell the story, to be honest with you.
John, before we let you go, I recently talked to the CEOs of one of your biggest competitors, T-Mobile, and it was on the topic of tariffs. Now, he told me his company will not eat tariffs. These prices, if smartphones go up, he will pass them on to consumers. Is that the same vibe over at AT&T?
Well, first of all, I don't know what's going to happen to smartphone pricing yet. As you know, we're sitting in the middle of kind of a transitionary period where the administration is trying to decide on what its final position is. And ultimately, it is the device manufacturer like an Apple or Samsung that will set the price that they'll turn back to us. So not knowing that they've changed anything, if they should increase the prices because of tariff-driven costs, like in the past, I would expect that probably that flows through to the consumer. Now, handset prices have been going up with or without tariffs over the last decade. And we've done a lot of things in how we've brought those products to market to try to help the consumer get through the fact that that device is getting a little bit more expensive. Sometimes we extend the amount of time that the individual pays for it, or we do different things on return pricing to help offset the actual first cost purchase. We'll continue to work with consumers to find a way to try to make sure that they've got a good, solid device to be able to use our network and carry forward. But I do ultimately expect if the device gets more expensive, that the consumer will probably over time have to bear that price, or they'll make some decisions such as hanging onto a device a little bit longer.
I know, John, you and I have talked in the past. You are an avid economic data watcher. It's just what you do. To that end, have you seen any signs of stress in your customer base as these tariffs start to hit the economy? Of course, we saw first quarter GDP decline. Consumer sentiment has now started to weaken for 5 straight months. Any signs of concern in your business?
You know, unfortunately, or fortunately, I guess maybe, at AT&T, we're really not a leading indicator. I think that you tend to find other parts of the retail segment that maybe have better indicators if you're at the early stages of an economic decline. our products and services are so essential to people's everyday lives, it tends to be something they hold on to for a very long period of time before they start making a decision of either not spending or spending down. I've not seen that in our business, Brian. Our business still is very strong. Customers continue to buy the services and they continue to pay us for them. And we feel really good about where we stand right now.
Good luck on getting this deal across the finish line. Again, AT&T looking to purchase all of Lumen's mass market fiber business for $5.75 billion. AT&T Chairman and CEO John Stankey, always good to see you.
Good to be with you, Brian. Thanks for your time.
Now time for some of today's trending tickers. We're going to check in on shares of Snowflake and quantum computing company IonQ. First up, Snowflake shares, they are soaring today. That's after beating first quarter earnings expectations, raising its full year guide. So strong outlook for quarterly sales. They did raise the full year forecast for product revenue to about $4.33 billion. Gotta tell you, Maddie, a number of notes in my inbox from smart analysts who've been doing this a long time. I got Evercore's Kirk Materne rates this one outperform, saying we believe the bump to full year revenue, despite the macro backdrop, illustrates management's confidence in the durability of near-term demand. RBC's Matthew Hedberg, another smart guy, also a fan of this name, says it remains his top large cap pick, takes his target to 236. Brent Tillett Jeffries says we believe the stock can continue to grind higher on a turn in the AI narrative in 26.
Yeah, and to that point, Cantor highlighting that any churn concerns were abated here. I also think it's really critical to note the company going public back in 2020, recording more than $1 billion sales in the quarter for the first time ever. That seems to be a key sticking point today, part of what's driving those shares higher. And you mentioned a lot of the notes coming to your inbox here, but we also had a slew of price target raises today as well from, as you mentioned, D.A. Davidson. We had Bernstein, Cantor, also TD Cowen this morning. And another thing that I noted earlier is that they talk about how they've been utilizing AI services in its cloud database platform. And when a company can, add in a little AI sweetener, that always makes the customers happy. The company saying in the earnings release late Wednesday that AI add-on did allow them to reach an additional 11,000 customers over the course of the quarter. Let's talk about quantum computing company IonQ soaring higher today after the company's CEO said it aims to become the Nvidia of quantum computing. Quote, we're in the business of quantum just like Nvidia and Broadcom are in the business of classical GPUs. That is according to the CEO in a conversation with Barron's. The shares are up almost 38% off the back of that commentary. And I think it is a very interesting story here that a CEO can just mention Nvidia and then you can have such a huge stock price. I do think part of what's also driving the tape a little bit here is the action that we've seen more broadly in quantum over the course of the week. Obviously, D-Wave having a huge week as well. IonQ getting themselves into a momentum trade that's already gaining some traction here.
Yeah, and this was one of the first quantum plays, pure plays to go public. CEO Niccolo de Masi saying there will be other people that copy us and follow us. They have always copied and followed us. Strong, confident tone there. It has been a name that we know has been in the crosshairs of short sellers.
Yep.
CEO did respond to that as well, telling Barron's there's a short report every few years, he said. They have all been baseless and nonsense. And we haven't even bothered trying to defend ourselves because they're all wrong.
We're Nvidia. Don't look at the short sellers. We're Nvidia.
It was good enough today.
It certainly was. It certainly was. Well, coming up here, Hinge Health began trading today on the New York Stock Exchange. We're going to hear from the company's CEO on the other side to discuss what's next following the debut. Stick around. Much more market domination still to come. We're down here on the New York Stock Exchange floor with Hinge Health CEO Dan Perez. A really phenomenal day because we know that the digital health IPO market has been kind of dry for some time. So Dan, talk to us now that you've already rung the bell. The stock is starting to trade. How do you feel?
We feel great. We're very grateful. We founded this company 10 years ago and we built it brick by brick. And the vision of automating healthcare is as real for us today as it was 10 years ago, and we still have many decades to go.
I know the stock is looking pretty good right now. I know you started offering at 32, it's up to 39. Thoughts on what you expect for the rest of the day and how you plan to keep the momentum going?
Thank you. I don't focus too much on where the stock price is today. We're early innings on the automation of healthcare, and I'm more concerned about where are we going to be in 5, 10, 15 years from now. But I know this is just one day in our history.
Well, I know all eyes are on you now because the rest of the digital health world is looking at what to do and where to go. So hopefully you can keep that momentum going.
We're looking forward to it.
Dan,
the weight of the world is on your shoulders right now. How are you feeling about that, and what are you thinking in terms of how you expect this day to go?
Well, thank you, Anjali. And look, I've had maybe a dozen digital health CEOs message us, say, congratulations, good luck, and don't screw it up. And look, we appreciate the enthusiasm, but look, we are not as worried as where the stock price ends today. Our vision is to use technology to automate the delivery of care, and that is going to take 10, 20, 30 plus years to continue to realize that vision as we chew across healthcare. And we're focused on physical therapy right now. Our technology automates away about 95% of human clinician hours associated with PT, and we've been able to transform outcomes, experience, and costs along the way. 20 million people have access to Hinge, but we're just getting started.
Absolutely. I want to talk about your previous attempt. You talked about going public back in 2022.
Yeah.
At that time, you were valued at about $6 billion, and it was just cooling off of that pandemic high.
Sure.
Any regrets about not going public sooner?
Absolutely not. And so look, we had a great valuation then, but since that moment, we have quintupled our revenue. We've doubled our gross profit or gross margin, essentially 10xing our absolute gross profit. We swung from losing $100 million a year back then to being free cash flow positive for 4 straight quarters and have a 12% operating margin here in Q1. And so very happy to go public at this point with these numbers and excited about the future ahead.
You talked about this just being the start of it. What other areas do you think the platform really is able to serve?
Well, that's a great question, Anjali. Look, our vision is to automate the delivery of care. And we've shown that we could exemplify this in physical therapy, where we're automating away by about 95% of human clinician hours. But we need to do this in other aspects of care. Our aim is to continue to peel away aspects of in-person care and then use technology to automate, say, 70 to 80% of provider interactions and eventually get to 80, 90+% of provider interactions. We must get comfortable with automating care delivery itself, because if we don't, care is not going to become more personalized, it's not going to become more convenient or accessible, and we're not going to lower costs unless we automate care itself. And healthcare, despite all the technology you see in a hospital, all those machines whirring about, most healthcare delivery itself is remarkably manual.
Another part of that, and I know you've addressed this before, adding technology has actually added to costs in the health system, and you're looking at ways to maybe make that more efficient. And this is also why digital health has had such a pullback in the market.
Yeah.
So defending what you do in terms of how you're able to overcome some of those barriers and work within the system, what else do you think is needed in order for digital health to have the comeback that it needs?
Look, healthcare is hard. But we are unlike any healthcare company that's come before. Most digital health companies before us have been focused on automating, say, back office operations associated with healthcare, or they're essentially a marketing company that's focused on healthcare, or they're technology on the periphery trying to enable one-on-one provider interactions. What makes us different is our technology is automating care itself, and that just hasn't existed, and that's why investors are so excited. And you see it in our numbers. Fantastic clinical outcomes for our members, fantastic financial outcomes for our customers, and then for the business, 81% gross margin, 4 straight quarters of free cash flow, 12% operating margin. So we know to build a really sustainable business, but what differentiates us is from what's come before is that we're actually automating care delivery itself. And that's very fundamental, and one of the reasons investors are so excited about this IPO.
Thank you so much for joining us.
Thank you,
Dan
Anjali.
Perez, Hinge Health CEO.
Awesome.
Back to you guys.
And the wait is almost over. Nvidia is set to report its first quarter results on Wednesday, May 28th, after the market close. Here's what investors have their sights on. Let's get to Yahoo Finance's Dan Howley. Hey, Dan.
That's right, Maddie. We're expecting Nvidia to report earnings per share of 88 cents on revenue of 43.3 billion. That would be a jump from 61 cents and 26 billion in Q1 last year. Now, Nvidia's shares have been kind of on a roller coaster since the start of the year. There's been issues related to export controls, the AI diffusion rules that the Biden administration had put in place before leaving office, fears over tariffs. But that seems to be kind of waning at this point. The Trump administration did away with the Biden AI diffusion rules, though they do say that they're going to put some other kind of regulation in place. They haven't kind of illustrated what that might be. The other thing is that they're allowing them to sell their chips to countries like Saudi Arabia, as well as the United Arab Emirates. We saw the news reports when Trump was in the Middle East that they'll be taking part in the Project Stargate in the UAE, and then in Saudi Arabia, they're expected to sell hundreds of thousands of GPUs over the next 5 years. So not exactly this year, but in the coming years. And as for Stargate, well, it depends on if that ever really kind of gets off the ground or not. There's been some funding stuff going on there with the U.S. project. But for NVIDIA, that's good news. Now, we did see Jensen Huang during Computex, the trade show in Taipei, Taiwan, criticizing the U.S.'s export rules, saying that they've been a failure so far, and basically that they're helping more or less Chinese companies build their own chips and kind of reach the ability that NVIDIA has to offer, or may reach the ability that NVIDIA has to offer when it comes to the power of their chips. So we'll see what that means for NVIDIA and the Trump administration, whether or not they'll ease export controls to China. There have been reports from Reuters that NVIDIA is working on a new chip that they would be allowed to sell into the Chinese market. You'll remember we're expecting a $5.5 billion charge that NVIDIA is going to have to write down based on the Trump administration's H20 rules. Basically, NVIDIA's H20 chip not being allowed to be sold in China is hitting NVIDIA's bottom line to a degree. So we're expected to see, obviously, healthy growth. It depends on what Wall Street, though, kind of is anticipating as far as, blow it out of the water, right? They had a beat and raise going for a while. The growth it's still going to be over 100% in some cases, but it's not the 200, 300% that we had seen. And after earnings, we've kind of seen investors pull back a little bit afterwards as a result of that. So I think it's about getting those expectations in line, and then really what we can see from Jensen and company as far as what they expect in the coming months with regards to regulation or tariffs. We know that the Trump administration is performing an investigation into whether or not they should have tariffs on semiconductors. So there's still a lot going on with regards to Washington and how that impacts NVIDIA. But for now, it still seems, though, the big tech companies, the Microsofts, Googles, Amazons, Metas, they're still on board with spending the billions of dollars that they said at the beginning of the year on their infrastructure. That's still in line. So NVIDIA is going to be the beneficiary of that for sure.
Dan, NVIDIA did struggle to start the year, and we talked a lot about it. There were different kind of puts and takes. Two big themes, Dan, we discussed were, there were concerns about DeepSeek, the Chinese startup. There were concerns about big tech and whether, maybe they were going to stop spending as much on building out their own AI infrastructure. Do you think those two concerns, Dan, as we head into this next earnings report, are they in the rearview mirror?
For big tech, yes. I think that people are kind of, they've seen that despite the tariff noise and questions about the macro environment, that these companies have said that they're going to spend the money that they said they were going to spend originally. So that doesn't seem to be a concern in the near term. As far as DeepSeek goes, NVIDIA's kind of spun up this narrative that these kind of models that require longer time to think benefit from more processing power. And so as a result, when you use a model like DeepSeek on higher end NVIDIA chips, you're going to get better results because it's able to process more information. So that's been the ongoing theme that we've seen out of a lot of tech companies, really. These kind of time processing models that, they'll be able to kind of get more information through the models, and that'll benefit them. So, I think for DeepSeek, for the most part, that's no longer a concern. I think DeepSeek is a concern for Washington, and that impacts the export controls, but not necessarily for NVIDIA itself.
Dan, thank you, sir. Appreciate it. Stick around. Much more market domination still to come.
As geopolitical uncertainty continues to rise and financial pressures mount, some companies are turning to one of the most common cost-cutting measures that they have, layoffs. As if raising prices wasn't enough, Walmart recently announcing that it's planning to cut about 1,500 jobs as part of a restructuring push to help simplify operations. The plan is set to impact teams and its global tech operations, e-commerce fulfillment, and its ad business as well, Walmart Connect. Meantime, earlier today, TD Bank saying it would lay off 2% of its workforce in an effort to scale up its digital and AI investments under its new CEO. Shares moving to the upside off of that news. Also last week, Microsoft announcing they would lay off 3% of employees across all levels, affecting nearly 6,000 people. The hits impacting all sectors, including the auto industry as well. Nissan intending to eliminate 15% of its jobs, or about 10,000 people losing their jobs across the globe. All in all, the recent uncertainty in the markets and global trade wars sparking this round of layoffs, impacting thousands around the world, though we haven't seen a rollover in labor market data just yet.
Well, President Trump's tax bill narrowly clearing the U.S. House of Representatives this morning. Passage sent bond yields higher before evening out ahead of the close. For more, let's bring in here Brett Ryan. He is senior U.S. economist at Deutsche Bank. Brett, good to see you on set.
Great, thank you.
So let's start there, Brett. The House does pass the Trump tax bill. So I'm just curious how you are try and think through the possible impacts on the American economy. You know, clients ask, what are you telling them?
Sure. So one of the biggest questions, first and foremost, is what does this do for the deficit? And in near term, we continue to see 6.5% deficits as a share of GDP. So that remains elevated, historically elevated, especially for an economic expansion, an economy that's not in recession. And there are a lot of moving parts to the tax code. There are some good positives in the near term for business investment, particularly, but they're also temporary. And the other big, the thing in the room, of course, is tariff revenues. And what do you assume for tariff revenues in that forecast?
Especially given that a lot of what we currently can forecast on tariff revenue is pre any deals or negotiations. How are you thinking about the totality of that policy? The fact that those tariffs could continue to be rolled back when you think about the impact on the economy and the consumer?
Sure. So when you're looking at this tax bill, you're saying, okay, what is the near-term positives from things like bonus depreciation, from a SALT cap raise, and what the total amount from those things are, versus, okay, what's the tax hike you're getting from tariffs? And so at around a 17.5% tariff rate, you're pretty much checking most of the positives here. In terms of straight revenue. If you think about it that way, the tax hike is going to be equal to, almost equal to the tax cut you're getting relative to the CBO baseline. So you're thinking about how much can they dial this back as we go along. Auto tariffs are going to be a key point for the EU, I'm sure. And what are you left with? Is it a 10% baseline? Is it going to be different for Canada and Mexico? Those are the sorts of calculations that are kind of more tricky in the timing of. To gauge what is the net impact of this tax bill on the economy.
Brett, we're talking obviously about bonds and yields. 10-year last I checked was knocking on 4.6. Is that move, do you think, is it because of these worries about debts and deficits you're flagging? Is it because recession fears are unwinding? Is it because of what you're seeing with Japanese government bonds? Is it all three? How do you make sense of it?
Yeah, so it's a little bit of all three, but I'd say the main thing that kind of sparks some of this is first you had this promise from the administration that they're going to see some serious cost cutting and putting touching mandatory spending such as Medicaid and putting that on a different trajectory. What you got out of this was promises to cut the spending trajectory 2029, and so of the 1.3 trillion in expected savings from outlays on this bill relative to the CBO baseline, you have 1 trillion of that is coming after the president leaves office. Begs the question, will it ever happen? The second part of that, of the remaining 300 billion over the next 4 years, 175 billion is just an NPV of student loan payments. It's sort of an accounting figment. And so there really isn't anything that's cutting cost for the next 2 years. They start to cut costs a little bit more in 2028. But we'll see what the end product is. They apparently brought forward some of this, some of the Medicaid stuff. They brought it forward a bit, but the Senate's about to get a hold of this bill. And so I would say the House bill is probably the floor for what deficits look like. The Senate is going to have its say, and that's probably going to make that even less cuts in terms of spending.
And how does that net out for the consumer? I heard you mention student loans, and I was looking at the bill earlier today and noticed that there is a change to student loan repayment plans as well. Things like income-driven repayment plans are no longer going to be in their current form. Where does the tax bill and then any pushback and changes that occur in the Senate net out on the consumer impact?
Sure. So I think it's going to be a net positive, but it's going to be, for some it's going to be more beneficial than others. Those at the lower end of the income spectrum, the bottom 10% or bottom 20%, after you account for the changes in transfer payments like Medicaid, they probably benefit the least and then could be slightly worse off, whereas income in the middle or top brackets are going to do fine.
And what does that do to the macro picture when you continue to have that bifurcation between these income groups and this K-shaped recovery dynamic as well?
Yeah, it doesn't have it really changed the picture all that much. But what it does is you're not thinking about a consumption-led boom here based on this tax bill. It's more steady state. This is preventing a big tax hike on the consumer from happening, right? There's a little bit of addition on it with the no tax on overtime and tips, and that's, in the near term, that's going to be a positive. But again, over time, if you realize these cuts in Medicaid starting in like 2029, those sizable chunks, it's going to be problematic. But again, that's if those cuts are realized. So we haven't really gotten to the third rail here yet, and that's what the bond market is focusing on, and particularly the long end. And you had an auction in 20 years that tailed significantly. Anytime that happens, if you just bought the 30-year a week or so ago, you're already underwater pretty significantly. So, I think in the near term, there's also some seasonality over the summer when it comes to Treasury bond yields. Typically, yields rise during the summer months for whatever reasons, and there are always going to be buyers. This isn't going to be a failed auction. There is no such thing. But the bottom line is this: if you were looking for any sort of belt tightening here on the spending side, you didn't get it. It's all backloaded, which begs the question whether it ever happens.
Thank you so much.
Thank you,
really
Brett.
Appreciate it. Thank you so much. Summer travel season is upon us. Airports could expect a 2% increase in passengers traveling this Memorial Day weekend compared to last year, according to AAA. But what is usually a booming summer season for airlines? This year it may look different as safety worries, economic concerns, and trade tensions create roadblocks for travel. U.S. airlines growing uncertain on growth prospects. How should investors navigate the sector? We're diving in with Yahoo Finance Playbook. Joining us, Bloomberg Intelligence Senior Aerospace Defense and Airlines Industry Analyst George Ferguson. George, great to chat with you. Thank you for making time for us. We've talked a lot over the years, you and I, about the luxury play when it comes to airlines, how they're seeking perhaps a higher income consumer. We were just talking with Brett Ryan about that here with us on set. Can these airlines continue to rely on higher income consumers to prop up their profits in this macro environment?
Yeah, so I think the answer is yes, certain airlines can still count on the high-end consumer to prop up earnings. It's going to be the big full-service, United, Delta, and American. Look, there's a lot of competition, I think, for the basic economy, probably even premium economy travelers. So I think there's probably too much capacity in the market for the number of those travelers that are in the space. And so I would expect some discounting to fill airplanes. So I think the more you're focused on just premium economy and basic economy as an airline, the more difficult it's going to be this summer for you to make money.
I'm curious, George, what about declining oil prices, that dynamic, oil here at 61? How much of a tailwind is that for the industry?
Yeah, look, it helps, right? So, I think we were doing some math on this, recently. Look, I mean, fuel prices are 20 to 30% of an airline's cost basis. So, if they're down 10% or something like that, you're going to save a couple points on cost, right? Maybe 2% of cost. It's just not a lot. I don't think you can cut fares enough, given that extra wiggle room you got from fuel, in order to make a large difference. It will help, But really what we're still seeing is an industry where in 2Q and 3Q, based on consensus, not even my numbers, but based on consensus, expectations are for lower EBITDA, earnings before interest, taxes, depreciation, and rent, which is typically how we measure, and lower margins, lower EBITDA margins. So not going to help enough.
Okay, so not going to help enough. What do you think moves the needle then? I know you sent over in your notes some areas where we could see airlines trying to be competitive when it comes to pricing. If they cut costs on, say, domestic flights, is that something that could be a little bit more impactful than lower oil?
Well, I mean, I think that's going to be what's driving the earnings number, right? Domestic business is the largest business for all airlines. And I think the discounting they have to do in domestic to fill airplanes, because you just can't fly, aircraft at 60 or 70% full. You'll never make money that way. So you got to discount them to get them up into the 80s plus percent. I think that discounting is what's going to hurt earnings. We still see international as being relatively strong for the summer season. I think really you get a pretty long booking curve for folks going international. So, right now the euro is sort of working against that traveler, but they didn't see that in the beginning of the year. And so I would still think demand is pretty robust across the Atlantic, at least for the first half of summer. And that will be a nice support for earnings. I think we're going to see whether anybody's starting to change their mind on Europe. It's been very U.S. point of sale. We'll see if everybody's starting to change their mind as we get into 3Q. My guess is you could find some. It may not be enough to create a lot of softness in Europe. So I think that's still a strength this summer, and that's what's part of the tailwind for United, American, and Delta.
George, I'm curious to get your take on another issue, too. These headlines we see out of Newark, George, these reports, they get a lot of attention. We were talking to another airlines guru like yourself, George, and he was making the point that these issues, air traffic controllers and air traffic, control system that needs upgrading and modernizing, his point to us was it is way beyond Newark. It is way more pervasive. Is that your sense, George?
It is. So, I mean, we have the air traffic control system that we've invested in over the past couple decades, and it's prevalent around the system, right? And so these aren't new. I think they tried to fix Newark by moving some of the control, not so much for the field itself, but airlines coming to and departing from Newark into Philadelphia. The FAA is having some staffing problems, which is making Newark relatively acute right now. But I would tell you that most summers we have problems at Newark. Weather usually creates it. This time we're down a couple of controllers. It doesn't help. But some of the cuts I'm seeing out of Newark United, I think, cutting less than 1% of their total capacity. In a lot of cases, they'll just merge some of that flying with other routes. I don't see it having a big effect on earnings. But again, Newark's going to be a pain flying into and out of this summer. But frankly, I'm a Newark flyer. What year isn't Newark a pain to fly in and out of? So it's a little more acute this year.
George, I'm right with you. Another Newark flyer. We'll get delayed together, George. It'll be fun. We'll catch up at the airport. Thank you, sir. Thank you, as always, for joining us. Appreciate it.
Thank you.
While we are wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.